Now we'll discuss about provision for tax. You will find this provision for tax always on liability side. Suppose you are studying some balance sheet. On liability side, in the opening column you find 10,000 and in the closing column you find 15,000. Now the question is, what is provision for tax? One thing I would like to tell you, it is on the side of liabilities, but it's not a liability, because I mean to say on this left side you will find accumulated profits, capital, liabilities and provisions. Basically it's a provision. Now you might be thinking, what is provision? Provision means, you can say, almost an estimated liability that you have to pay in the future, but you don't know about the exact amount, but you have to pay it. That is provision. So this is provision for tax, means this is the estimated amount of tax that you have to pay during the year. Now let me explain how this provision, this amount, is created and it comes on the liability side. Suppose you are preparing profit and loss account for the year ended 31st March 2011 and your net profit is rupees 10,000. You know, in every country everyone has to pay income tax. So this company or this firm has made a profit of rupees 10,000, and suppose in India, for example, the tax is charged at 40%. So it means, as per your books, the net profit is rupees 10,000. So you will have to pay 4,000 as tax to Government of India. So I will reopen this net profit, by net profit on credit side, then to provision for tax rupees 4,000, to net profit 6,000, and the profit and loss account is closed. What it means? Your estimated liability is rupees 4,000, because as per your books the profit is 10,000 and you have to pay rupees 4,000 as per your opinion. When you meet the income tax officer with your books, maybe he doesn't agree with this income of rupees 10,000. Maybe he is not satisfied with some expenses or incomes. Maybe you have to pay the tax rupees 5,000, maybe you have to pay only 3,000. But this is the estimated value that you have to pay tax of rupees 4,000 to income tax department. That's why it is called provision for tax. So now today is 31st March 2011. Now what will you do? You have reduced your profit by rupees 4,000. So one thing is clear, provision for tax reduce your profits, and number two, it becomes the estimated liability. So on balance sheet, as on 31st March 2011, on liability side you will show provision for tax rupees 4,000. So this is the system. So one thing is clear from this example, that creation of provision for tax, it reduces the profit. Secondly, it is a non-cash transaction in profit and loss account, because this is the estimated liability for future, but you have not paid any amount yet. So this is a non-cash transaction in profit and loss account, which is shown on the debit side of profit and loss account. So let me tell you how the journal entries are passed. I'm going to pass the journal entries for the same example. It was 31st March 2011 and you created liability of rupees 4,000. So the journal entry will be profit and loss account debit to provision for tax 4,000. Suppose you get the date with income tax officer on 1st May 2011 and you will take your books to the income tax department. He will study your books. Suppose this income tax is settled by both parties at rupees 3,900. However, your estimate was 4,000, but income tax officer is satisfied at rupees 3,900. So you will have to pay tax. The amount will be 3,900. So the journal entry will be provision for tax account debit to cash 3,900. So in the next year, 31st March 2012, again you are preparing profit and loss account, and your net profit, that is rupees 15,000. So please reopen the net profit on the credit side by net profit before tax rupees 15,000, and your strategy is that you have to create provision at 40%. So 40% is of 15,000, that is 6,000. But be careful. Last year you created provision of rupees 4,000, but you had to pay only rupees 3,900. So 100 rupees provision is still lying with you, and you have to maintain it at 6,000. So you need to create only 5,900 rupees. So provision for tax 5,900 to net profit, in bracket you can write down after tax 9,100. So this is the system goes on for the coming years. So if you find any provision for tax on liability side, you have to find out two figures: how much tax was paid during the year and how much provision was created for tax. Two things. The tax paid during the year, that will be shown on the outflow column in cash flow statement. Number two, the provision created for tax during the year, this amount will be added to net profit to reach the cash from operation. So I strongly suggest you, if you find any item regarding provision for tax, you should prepare an account, a ledger in your working notes. So let's prepare the provision for tax account, because it is always shown on the liability side. So it has got the credit balance. It means it carries the credit balance. So opening balance will be on credit side by balance BD, and closing balance will be on debit side to balance CD. And by profit and loss account on credit side, and in the inner column you will write provision made, and on debit side to cash, in the bracket you can write down tax paid. So these are the four items you should prepare in the provision for tax account for the convenience of the solution of question.